Hi, good evening, friends. Good evening, students. How are you? So, today is our fourth lecture on NR taxation, non resident taxation. I hope we started with the residential status, then we understand what when the income is deemed to accrue or rise in India, when the taxability arises in the hands of non resident. Good evening, Sanjay ji. And then we discussed the tax rates. So, slowly, we are progressing from basic to advanced. So I hope you understood the how we determine the residential status of individual or company. In case of company, we apply POEM provisions, place of effectiveness provisions. More importantly, why the concept of residency is important. Then we came to taxability. When the income is taxable, how is it determined? In case of non-resident, if income is accruing or rising or received in India. Then we saw the extended meaning of accruing and arising under section 9. And we discuss in detail each cross by cross section 9. Then we discuss the different tax rates and the capital gain applicability on non-resident. Okay. Today our topic is TDS and exemptions applicable in case of non-resident. So till last class, if there is any doubt, do ask me. Yes. Till last class, if you have any doubt, do ask me. See, the taxation, the subject of direct tax is quite wide. So what happens is that as we move ahead, we keep forgetting the topics which we discussed earlier. So the best way is keep revising, keep revising. Try to teach, try to have a group of friends where you can discuss the topics, where you can discuss the questions, the problem, the confusions and all. You know, it helps a lot way in actually clearing in actually having a concept clarity. uh, See, one of the difficult area in CA is that it's a correspondence course. You don't get into the college and get that college environment where you have a friend circle, you can discuss things. So this being basically a self-study course, this hampers this friendship, a bond of group of friends. The bond is not created, and more so now this YouTube classes. At our time, we used to go to the physical coaching classes, and there we used to meet people and make friends, which are still there with us. So, if you get an opportunity, make friends, which are of which are sailing in the same boat, you know, and discuss whatever subjects you are studying, whatever they are studying, discuss. So it will clear the topic a lot and will help you to retain interest. The subject will remain lively. Okay. So the topics which we have covered, if you have any doubt, if you have revised that, if you have any doubt, do let me know. Today we are discussing the TDS, tax deduction at source. If I ask you what is TDS, though this is not the precisely my topic, can you answer me what is TDS? Is it taxability? Is it taxable provision? See, if you know, if you go to the basics, there are three or four types of provision in the income tax. One, which create chargeability, chargeable provisions. Then we have the computational provision, withholding tax. Yeah, TDS is a withholding tax, but what type of provision is it? It's not chargeable. It not create a chargeability. It's not computational. Then we have the recovery provision, which provides how the tax which is computed will be recovered. So TDS comes under the recovery provision. And lastly, then we have the assessment or the penal provisions. So my charging sections are section 4 and 5. Then I have a computational section, my entire of 5 heads of income. They provide how the income is computed, how the tax is computed. And tax is recovered either by way of advance tax or by way of TDS or by way of self-assessment tax. So TDS is nothing but a mode of payment of tax. Mode of payment of tax. I'm discussing this because a very fundamental question arises from this is if a particular payment is not liable to tax, is not chargeable to tax, is not taxable, can TDS be applied on such income? This is a very fundamental question. We answer this as we study today in our class. So, in case of such non-resident, this is actually the fundamental of TDS provision in case of non-resident. In case of non-resident, the tax is deducted under section 195. It's the most important section. If you're dealing with the international taxation, then the non-resident taxation, then this section you will use in your daily practice. This is the most important section which the Big Four uses daily. I'll tell you why. As we study, you will understand why. What did it say? It applies on what type of payment? Any sum chargeable under the Act other than salaries, interest, referred in section 194 LBLC. Deductor. Who has to deduct tax under this section? Any person. Any person means there is no reservation. Such person may be R or NR. Everybody. Yes, a non-resident is also required to withhold tax. What? How can it be, sir? Yes. So, sir, you are saying, acha, for whom tax is to be deducted? Who has to be deductee? Who has to be recipient? He has to be non-resident or a foreign company. So, are we saying that a non-resident paying a sum to a non-resident is required to withhold tax? Yes, this is what it is written. What can I do? It says deductor can be any person includes non-resident, and the recipient has to be non-resident. So NR paying to a NR is still required to deduct tax under section 195. But when an NR is required to deduct tax on the payment to NR, or for that matter, when an R or when any person is required to deduct tax on payment to NR, he is required if he makes a payment of any sum. The term any sum is very wide. So a resident making payment to non-resident or a non-resident making any payment to non-resident. In both these cases, these persons are required to withhold tax to deduct TDS. So this gives a weird, this is illogical. This gives us a weird conclusion. A non-resident making payment to non-resident of any kind, is he required to withhold tax as per Indian tax law? No. See, the term any person is subject to the words, which is any sum chargeable under the Act. So, they are required to withhold tax. This is right. The R making payment to NR or NR making payment to another NR, they both are required to withhold tax. But when? When the sum so paid is chargeable under the Act. Now you understand? If the payments made by this R or NR to another NR is taxable in India in the hands of the recipient, if these recipients are liable to pay tax on this income, on the sum they received, then the payer is required to withhold tax irrespective of the status of the payer. So, what are the conditions under section 195? First, the recipient has to be non-resident. Unless recipient is non-resident, section 195 does not apply. Secondly, the payment which is being made should be sum chargeable to tax under the Act. So, such sum should be taxable in the hands of non-resident. Then, if the sum is taxable under the Act, under the Income Tax Act, Indian Income Tax Act, then whosoever is the payer, he is required to withhold tax. So, does it mean if a non-resident is paying to another non-resident, then they are required to withhold tax? Yes, my dear friends. Yes, yes, yes. You guys have already studied this. I make you remember. In the last class, we discussed about Vodafone transaction. Remember? What was the facts? What happened in the Vodafone transaction? There was a Netherlands company, assuming it has a wholly owned subsidiary in CGP, Cayman Islands. It has a wholly owned subsidiary, Hutch India. Then there was a Vodafone UK. What Vodafone UK did? It purchased a share of CGP from Netherlands. So it makes a payment to Netherlands, makes payment. Entire case before the Supreme Court. It was not, see, you know the case name is Vodafone. So who is earning the money? Who is the assessee here? Here is assessee is he is a seller. He must be earning the money, even if taxable. That's a separate question whether it's taxable or not. You know, that was a query, that was the issue. But it was taxable, there was no issue that it was taxable in the hands of Hutch Netherlands because he's a seller. The gain arises to the seller, not to the purchaser. But who approached the court? Vodafone. Why? Because what the tax authority said, tax authority did not send the notice to the Hutch Netherlands. They sent notices to Vodafone for default in its TDS obligation. Which TDS obligation? TDS obligation under section 195. So what the revenue authority was saying, that this sum, the amount which the Netherlands company had received from the Vodafone UK, was taxable in the hands of Netherlands in India, and therefore by virtue of section 195, sum chargeable under the Act, the Vodafone was required to withhold tax while making payment to Hutch Netherlands. And Vodafone, since has not withheld tax, and therefore he is a assessee in default. And this was the precise issue before the Supreme Court, whether Vodafone is assessee in default or not. To decide this issue, the Supreme Court has to decide whether the amount so paid by Vodafone to Netherlands is sum chargeable to tax in India or not. And therefore, the Supreme Court has to go into the taxability. Because in case of non-resident, the TDS obligation is dependent upon the taxability. You're with me? If the sum is taxable in India, then the payer is required to withhold tax, irrespective of the residential status of the payer. See, here the Vodafone UK is non-resident, no doubt. The Netherlands is non-resident, no doubt. So the issue was non-resident making a payment to non-resident, and he has been defaulted for not deducting tax in the section 195. So whether payer is resident or non-resident is irrelevant. You just have to see whether the recipient is non-resident and the sum which he is receiving is chargeable tax under the Act or not. See, I give you more examples. You have studied this. If you remember, we discussed in section 9 itself interest, royalty, and FTS. While discussing this, we discussed when they accrue or arise, where they accrue or arise. We discussed if the payer is government, then they accrue or arise in India. If the payer resident, one of the point was if the payer is non-resident, then they are taxable if they are utilized in the business or profession in India. Or in case of royalty and FTS, if they are utilized for earning any income from any source in India. You remember? This was the precise difference between interest versus FTS and royalty. Here also, the non-resident is paying interest to another non-resident. And if such interest is taxable in India because the payer non-resident has utilized the money borrowed in his business or profession in India, then this non-resident who is paying the interest is liable to withhold tax on payment to this other the lender who also non-resident. So it is very much common that a non-resident is under an obligation to deduct tax while making payment to another non-resident. The only condition is that the payment, the amounts of paid should be chargeable to tax in India. See, this is the precise difference. This is a very important difference between domestic TDS and the international TDS. By domestic TDS, I mean TDS on payment made to resident, and by international TDS, I mean TDS on payment made to non-resident. In case of, if you remember, in case of payment made to resident, there are series of sections which describes the nature of payment on which tax is to be deducted. If the payment is in the nature of salary, you deduct a tax. If payment is in the nature of commission, you deduct a tax. If payment is in the nature of interest, you deduct a tax. If payment is in the nature of commission, you deduct a tax. So a whole series of sections are provided: contractual payment, professional service, technical service, whatever, which provides that if so, whether tax is to be deducted or not is dependent upon the nature of the payment, which is being made to the resident, if the recipient is resident. But this is not the case in case of non-resident. In case of non-resident, if whatever be the nature of the payment is, if such amount is taxable in the hands of recipient non-resident in India, then the payer is under an obligation to deduct tax. You understand the difference between domestic and international TDS? In case of domestic TDS, the Act lists down a lot of nature of payment, different nature of payment on which tax is to be deducted. But in case of non-resident, it's not the case. What the Act provides, it simply provides, if such amount is taxable in the hand of non-resident, then the payer has to deduct tax. If you see, on capital gains, if except the immovable property, on capital gains, say I as a resident sell shares to another person, whoever may be that other person, and so the resident sells shares to another person, and he earns a capital gain of say rupees 5 crore on sale of such shares. Is the payer required to withhold tax on this 5 crore? This 5 crore is clearly my income, is the income of the resident. But is the payer required to withhold tax? Answer is no. There is Mr. Sanjay, just a minute. I come to your query. There is no provision under the Act which requires the payer to deduct tax on capital gain earned by the resident. Why? Because there is no such provision that whatever the amount which is taxable, the tax has to be deducted in case of resident. In case of resident, the law only lists down the different types of payment on which tax to be deducted. But had it been the case of NR selling shares to whomsoever and earning a capital gain of 5 crore, and this capital gain is taxable in India because the capital asset is situated in India, then the payer has to deduct tax on this 5 under section 195. Understand? So the query is, in domestic TDS, payee can be NR also. Yeah, no. The payer can be R or NR, but the payee, the residential state of payee, he decides whether it's a domestic or international TDS. So payee means the recipient. The recipient, if recipient is R, then it's domestic. And if recipient is NR, then it is international. And then section 195 applies. 195 applies only when the recipient of the payee is non-resident. If payee is NR, then the domestic doesn't apply generally. We see the exception. You understand the basic difference? For NR, any sum chargeable tax is subject to TDS. Can you think of why? If you see, the scope of TDS is limited in case of resident, but it is very, very wide. Every payment which is taxable is subject to TDS in case of NR. Why? Because government have a fear that a non-resident may receive an income and he may disappear. He may disappear in 700 crore of people. It will be very hard for the Indian government to find such person once he gets the income. So therefore, the obligation is cast on the payer itself, so that at the first moment, at the moment where the income arises, the government receives its tax share. So the payer is required to withhold tax. Payer is required to withhold tax if the payment is subject to income tax in India where the recipient is non-resident. Understand why? Because to ensure the recoverability of tax. In case of resident, it's easy to recover. Even tax TDS has not been deducted, the government can recover the tax from resident, but it's not the same case in case of non-resident. So it's very difficult to recover tax from the non-resident because locational jurisdiction is not there with the Indian government on such non-resident, and therefore the responsibility is put on the payer to at first deduct the tax and then only make the payment. Okay, got it? One more difference between the R and NR TDS. In case of R, if the domestic TDS, if the recipient is resident, then tax is deducted generally at the base rate, the rate provided in the different section, 2%, 5%, 10%, as the case may be. In case of non-resident, for the similar logic, the TDS deducted on the rate plus surcharge and cess. Surcharge and cess. This is why, because I as a government want to collect complete tax revenue as a TDS only. In case of resident, it's only in case of salary TDS. The tax is deducted inclusive of surcharge and cess. For all other sections, tax is deducted on the base rate. But in case of non-resident, the base rate is to be added by surcharge or cess, applicable surcharge and cess, while deducting TDS. Okay. So, Section 195 says any sum chargeable under the Act is required to deduct TDS. Who will deduct? Any person, he may be R or NR, not relevant. The recipient has to be non-resident or a foreign company. The rate at which tax to be deducted, rates in force, means the rate on which such income is actually taxable in the hand of non-resident. You're getting everything is coming from the same logic that it is difficult to recover the tax from non-resident, and therefore whatever the tax which the non-resident ought to have been paid or to pay shall pay on such income, it is already been deducted at the time of TDS, the complete tax at such rate on which such income is taxable, including surcharge and cess. Tax to be deducted at the time of payment or credit, whichever is earlier. So at the first moment when it becomes an income. The word any person used above is intended to include both resident and non-resident, as I told you. Therefore, non-resident person is also required to deduct tax at source before making payment to another non-resident. So, NR making payment to another is also required to withhold tax. If the payment represents income of the payee, non-resident, chargeable to tax in India. Therefore, if the income of payee, non-resident is chargeable to tax, then tax has to be deducted at source, whether payment is made by resident or non. Understood? Second, in the case of interest payable by the government or public sector bank or public financial institution, the tax shall be deducted at the time of payment thereof. So, where the interest is paid by the government or public financial institution, then the tax has to be deducted at the time of payment, not at the time of credit. Okay. Now comes a different. See, if you see a TDS law, if you understand the concepts, no, the basics, why this provision was introduced, it will be very easy for you and it will be very interesting for you to retain the tax law and to interpret it. See, if you see, the TDS is, I told you, is a recovery provision, is a provision to collect the tax. Whose duty is it to collect the tax? Is it my duty, my as an assessee duty, as an individual, as a payer, is it, or as a Indian public? Is it my duty, or is it duty of the Indian government? Whose duty is it to collect a tax? Of course, the duty is of the government. But government has delegated this function to payer, and payer is required to withhold tax and deposit it to the government. So when I deduct a tax on any payment, I act as an agent of the government. You're with me? I act as an agent of the government and collect tax on his behalf from the payment which I made. You're with me? And to act as your agent, that too mandatory, not voluntary. I didn't volunteer to act your agent. You made the TDS provision and you made me a de facto agent. If I defaulted in this responsibility, what you do? You make my life hell. What are the consequences if I don't deduct a tax? I am hold as a assessee in default in section 201. Then interest is levied under section 2011A only for assessee. Then the corresponding expense is disallowed. And on this disallowance, you charge tax plus interest plus penalty. These all consequences I face, and then there's a penalty as well under 271C for non-deduction of tax, TDS. All these consequences I face for not deducting tax. And for the default, not deducting tax, which is not even my responsibility. This is a recovery provision. The government should collect it. I am only benefiting the government by acting as its agent. And if I don't do my responsibility, you punish me harsher than the person who has actually shown bogus expense. If some assessee has shown bogus expense, then his expense is disallowed. He is required to pay tax, interest, penalty. But if some person doesn't deduct tax, TDS on any payment, then the expense is disallowed. He has to pay tax, interest, penalty. In addition to that, he is held to be assessee in default, pays interest for assessee for non-deduction of late deduction of TDS. He is subject to penalty equal to the amount of TDS, and he faces such a harsh consequences. Courts have said that TDS provisions are draconian provisions. My responsibility is to pay my tax. My responsibility is not to collect the tax over there and deposit it to you. That's your responsibility. You means the government. Okay. So government has actually cast its own responsibility on me, white TDS, and has provided a lot of penal consequences. Now what happens is that whenever I made a payment to NR, I fear a lot, because if in future it is held that such payment was taxable in the hands of NR, then you will hold my neck as you did in the case of Vodafone. See, whose tax liability was it? It was tax liability of Hutch Netherlands. But who has to face 12 years of litigation? It was Vodafone as a purchaser, because he, as per government, he was required to deduct tax and he didn't do it. See, I am only acting as your agent. Vodafone is acting as a collection agent. The primary liability is of the assessee who is actually earning the income. You should first assess Hutch and collect the tax on him. If I have purchased share for 100 crores, then I have made the payment of 100 crores. then he is the beneficiary of 100 crore. He has 100 crore. You collected 30 crore rupees tax or whatever the tax amount from him. Why are you bothering me? This is the law. So what happens is that in case of making payment to NR, I always fear that I should deduct tax. But I tell you one more practical situation. Generally, when there is an agreement with NR, it's always grossed up. The NR says, see, I am providing this service to you, to the resident, and I want rupees 100. Now, I am not concerned about your loss. If you need to do TDS, you gross it up. If you need to do 10% TDS, you think this taxable, you gross it up. So actually, the TDS is the cost which is borne by the payer. Yes, sir, this generally, practically. So if a resident is making payment to non-resident, he always fear whether this amount is taxable or not. Or sometime in the future, the government may allege that it was taxable and you defaulted in your TDS obligation. And therefore, and if I deduct tax on conservative basis, then also is a problem because it's a cost on me. Therefore, Section 195 contains two sections, 195.2 and 195.3. 195.2 says that if there is a situation where the payer is into dilemma whether the amount it's paid it's subject to TDS or not, or is it the full amount which is subject to TDS or not. Say it might happen I have purchased some equipment and I am also paying the same NR for the installation. Then I may think that the purchase is from outside of India, pure import, not liable to tax and therefore not subject to TDS. But installation is happening in India. So this amount, the amount pertaining to installation, should be subject to TDS. But I'm not sure. In future, the tax officer may say that you have loaded the installation amount onto the sale of goods. You are saying that you have purchased machinery for rupees 100 and you have paid 10 rupees for the installation. If I deduct TDS on rupees 10, in future the government may say the machine was actually of the worth of rupees 70 and 40 was for the installation. You should have deducted tax on 40 rupees, but you have deducted only on 10 rupees and therefore you are assessing default. So this type of litigation is very common in the case of international taxation, and therefore I feel, therefore section 195.2 is there, which provides if this is the case, then you can apply to the AO tax officer and request him to determine the amount on which tax has to be deducted. And whatever amount is determined by the AO tax officer, then you shall not be held in future as a assessing default if you deduct tax on such amount. Even if in future, say in this example, say the payer applied to the AO, say I'm making a payment rupees 100 for the purchase of machinery, rupees 10 for the installation. And my view is this 100 is pure purchase of goods, not liable to TDS, and this 10 is liable to TDS. The tax officer may say in its certificate in section 195.2 that I feel the machinery is for rupees 90 and 20 is for the installation, so you deduct tax on rupees 20. Okay. So the payer accordingly deduct tax on 20 and make the payments. Subsequently, in the assessment of non-resident, it is held that it was actually 70-40. The 40 rupee was taxable in India. But now, since the resident, the payer, has deducted tax on the basis of certificate of AO, now the payer cannot be held to be assessed in default, and he has not done any default of his TDS obligation. Okay. So there is section 195.2, which says that the deductor, which makes the deductor eligible. You understand? Why deductor is interested in determining on what amount tax is to be deducted? Because there are penal consequences on the deductor if he defaulted or if he shortly deducted the tax. So what it says, deductor may request AO tax officer to determine the amount out of the total payment on which tax is deductible if deductor considers that tax is not deductible on whole of the sum. You with me? But at the same time, It may happen that here the payer may say, I am not concerned whether this 100 rupees is for purchase of good and 10 rupees is for installation. See, I don't understand all this. I will deduct TDS on whatever amount I pay to you, rupees 110. I don't want litigation in future. This clinic I need. I don't want to take any risk. I deduct TDS on rupees 110. That's a problem for non-resident. So section 195(3) empowers the recipient, non-resident, to approach the tax officer and obtain a lower or nil withholding certificate. So under section 195(3), the recipient may request. Now here the non-resident we are talking about. 195(2) is on deductor. 195(3) is on recipient. The recipient may request AO to grant a certificate authorizing him to receive such amount without deduction of tax under this section. Okay. Lastly, so you understood what we discussed till now? We discussed that under section 195, everybody, irrespective of his residential status, is required to withhold tax on making payment to 1 NR if such amount is chargeable to income tax in India. So irrespective of the nature of the payment, if the payment is taxable in India, then the payer is required to withhold tax under section 195. At what rate? At the rate of rates in force, including surcharge, applicable surcharge and cess. When? At the time of payment or credit, whichever is early. Okay. Yeah. Then we discuss section 195(2), which authorizes the payer, deductor, to approach AO to determine the sum on which tax is required to be deducted. Then there is section 195(3), which authorizes the recipient, non-resident, to approach AO to determine to obtain lower or nil withholding tax certificate. Then section 195 say, even if the payment is not subject to tax, still you have to furnish a form specifying the amount and the nature of the payment. So this form are generally form 15CA and 15CB. So CB is a certificate which the chartered accountant gives, certifying that the payment so made is not taxable. 15CA is the form which the bank requires the payer remitter to fill. So by this way, the tax department gets to know about how all of the payments which are being made to the non-resident or to foreign companies, whether they are subject to TDS or not. They have a database. They know whatever amount is being paid to non-resident or the foreign company. So every person making any payment to non-resident or a foreign company, whether or not chargeable under the Act, even if the sum is not chargeable to Act, meaning thereby, even if tax has not been deducted on such sum, still the person making such payment shall furnish the prescribed information in respect of such sum. You are with me? Hand out? So this completes our section 195. Wait a minute. Okay. So 195 is a general section on in respect of payment made to the non-resident. Right? It says any sum chargeable to tax other than salaries. So if salary is being paid to non-resident, are we not required to, is the employer not required to deduct tax? Or other than interest referred to in section 194 LB or LC. In such case, is the payers not required to withhold tax? No, they are required. There is not even a single penny of amount which is actually chargeable under the Act and which is being paid to non-resident, and if tax is not deducted on such. So, though 195 is not applicable on the salary and interest referred to in section 194 LB or LC, they are different sections. All of the payments are covered by section 194 LB. If you see section 192, yeah, The same section which you studied in the case of domestic TDS. Now we will discuss some similar same type of section which you have studied, but they are also applicable to both. They are applicable to both, to resident as well as to the non-resident. So even if the payment of such type is being made to the non-resident, the tax is deducted under these section, not under section 195. Why? Because they are specific. If you know, there is a interpretation or the theory, interpretation theory, which is specific versus general. Have you heard about it? But this is a theory of interpretation of law. What it says that if there are two provisions, one is specific, applicable to the facts of the case, and such facts are also covered by general provisions, then the specific provision shall prevail over the general provision. This is called specific overrides. The specific versus general. Okay. So my section 195 is a general section. It applies to all type of payment, irrespective of the nature of payment. So such payment is taxable in India. It applies to all type of payment making to NR. But if there is some specific section to a specific type of payment, then we will apply such section in place of section 195. You with me? So though section 195 says any sum chargeable to other than salaries, even if it had not said so, still TDS on salaries shall be deducted in section 192. Why? Because in case of 192, which we have already studied, the recipient is any person, means R or NR. So if the employee is R or NR, is not relevant. If the salary so paid is taxable in India, then the employer is required to withhold tax. Again, the employer may again be R or NR. So if the employee is NR, then when can it be that the salaries are taxable in India? Tell me. We have discussed this. Right. Tell me. In case of NR, when the salaries are taxable in India, it is taxable in India when the services are rendered in India. Perfect, Sanjay sir. When the services are rendered in India, then we deem to accrue or rise in India. And there was an extension that if you are an Indian citizen and government employee and you are being deputed outside India, then also your basic salaries are taxable in India because they are deemed to accrue or rise in India. Section 9(1), if you remember. So in such case, if you remember, we did the practical question as well, where the employee was normally working in Ministry of External Affairs and they were deputed to foreign embassies and they were receiving a salary from the government of India. And the question provides that they receive a salary of rupees, say, 5 lakh, then they receive allowances, rupees 1 lakh, perquisite, 2 lakh. What is the amount taxable? So we used to say it's only 5 lakh after the standard deduction is taxable because these allowances and perquisite are exempt. Now, if this is taxable, then this employee was in any case non-resident because he was staying in foreign embassy for the entire year. So if this says taxable in his hand as a non-resident, then the government of India is required to withhold tax on this salary under section 192. Okay. We also did the examples of something like the employee is working with Microsoft. He came to India for, say, 6 months and work from home here, and he qualifies as non-resident, but the salary which he received for services rendered in India is taxable. And in this case, Microsoft, though NR, as an employer, has an obligation to deduct tax on the salary of the employee. You are with me? So this we have already been studied at the time when we discussed 192. We are just listing down the provisions which are applicable to both resident and non-resident. So first is 192, income under the head salaries. The rate at which tax is deducted in section 192, I will not tell you, you will tell me because you have studied. This is not a new topic. We are only revising the TDS provisions. This is the average rate. So what do? You estimate that all the salaries income of the employee, you compute the tax liability, and then you divide that tax liability divided by 12 by number of months, and you deduct tax of such amount in each month. The tax is deducted at the time of payment. See, by virtue of section 912, salaries deemed to accrue or rise in India if services are rendered in India. Okay. Therefore, if a non-resident renders service in India, average rate of tax, right? The salary income would be chargeable tax in India, and the employer has to deduct withholding tax in accordance with the provision of section 192 at the rates in force for the financial year in which payment is made. You with me? The question comes, if the salary is taxable in India and therefore tax has to be deducted, the salary receivable by the non-resident, then the question comes, generally such non-resident must be receiving a salary in foreign currency, but tax has to be deducted in INR. Then how the foreign currency is to be converted? What the law says is you will convert the foreign currency into INR by applying the exchange rate of which date? Exchange rate of last day of the month immediately preceding the month in which the salary becomes taxable, salary was paid or accrued. So if the salary is paid in the month of May, then I will apply to convert this salary into INR the exchange rate as it applicable on 30th April. 1 month before. You with me? In case where salary is payable in foreign currency, which normally does in case of non-resident, the amount of tax deducted is to be calculated after converting the salary payable into Indian currency at the TTBR adopted by the SBI as on last day of the month immediately preceding the month in which salary becomes due or is paid in advance or in arrears. Understood? Immediately in the month in which it becomes taxable, the month preceding that, the last day of the such preceding month, the exchange rate which was applicable, which was in force as on that date, shall be applied. Okay, you with me? Okay, so next section we are doing is section 192A, very much similar to section 192. The nature of payment is accumulated PF amount if taxable in the hands of employee. Deductor, trustee of the employee PF scheme, means the PF trust, which is making the payment of PF amount to the employee. The employee may be R or NR. TDS is 10% at the time of payment. Why we discuss this? Because even in this case, the recipient is non-resident. The recipient is non-resident. He is withdrawing his PF amount, and such PF amount, if happens to be taxable in India, then the PF trust is required to withhold tax at the rate of 10%. There is a threshold of 50,000. No tax is deducted if the amount is less than 50,000. We are quickly doing each section. We are not going in depth of these sections because they are part of tedious chapter which you have already been covered. Then there is section of 194B. Actually, there are three sections: 194B, BB, and BA. All these three sections are qua lottery income. So 194B is winning from lottery or crossword puzzle or card game, other game. Here, deductor is any person and recipient is also NR, includes NR, maybe R or NR. So even if there is an NR who wins a lottery in India and such lottery income is taxable in India, then the tax on such lottery income shall be deducted under section 194B, not under section 195. The tax rate same, 30%. But if the recipient is non-resident, then this 30% shall be increased by surcharge and cess. Okay. But if the lottery winner is resident, then tax is deducted at the 30%. But if it's non-resident, then tax is deducted at the rate of 30% plus surcharge plus cess. Time of deduction at the time of payment. So there is a threshold of 10,000 for each income. Then there is 94BA, which is applicable on online lottery income, winning from online games. Any person, recipient may be non-resident, 30% net winning at the end of financial year. Okay. We are discussing this fast because we have already understood. Otherwise, each of these sections requires 10 to 15 minutes of discussion. They are in-depth sections. Section 194BB, similar to 194B, here it's applicable on horse races. Here also, if you see, the recipient includes NR, therefore we are in this chapter. The TDS rate is similar, 30%. Tax equivalent at time of payment, there is a threshold of 10,000, similar to 194B. You know the threshold in the case of 194BA, online games? You know. I have written 10,000 in case of 194B, in case of BB. Is there a similar threshold for 194BA as well? So for BA, the threshold is rupees 100 per month. Students. 194G. 194G is commission on sale of lottery ticket. So in section 194B, we discuss the winning, the TDS on winning of lottery income. In case of 194G, we are discussing the commission, means the person who is selling the lottery ticket, who is organizing this lottery game, is getting a commission. So a tax is levied on this, his commission income. Commission remuneration of price on lottery tickets, direct any person. Recipient means any person. So any person includes non-resident as well. Tax to be directed at 2%, payment required whichever is earlier, threshold of 15,000. Okay, then there's a unique section of section 194N. It is applicable on withdrawal of cash withdrawal. Why I said it's a unique section? Can you tell me? Why it's a unique section? It is not on joys, not on enjoy, not on income. Perfect. So what the Sanjay is saying is perfectly fine. See, I told you in the beginning, TDS provisions are recovery provision, recovery of tax. So for recovery of tax, there should be at first place tax liability. Whatever amount I am paying, that amount should be liable to tax in the hands of recipient. If you see, my whole of the TDS provision are like that only. They are TDS on salary because salary is taxable in the hands of employee. TDS on commission because commission is taxable. TDS on interest because interest is taxable. Professional service, technical service, and all. But 194N is the unique section. It applies on withdrawal of cash from my own account. So what it says, I have a bank account, my own bank account with a bank. If I withdraw cash from such bank, is withdrawing cash my income? Of course not. The money lying with the bank is my money only. I'm just withdrawing it. If I put a money in my wallet and then I withdraw it from my wallet, the withdrawal doesn't become an income. There's no two party involved. It's just withdrawal of my money from bank into cash. I may deposit it in the next day. Yeah, it doesn't have an income character. It's not income. But still, 194N says that on withdrawal of cash, the assessee is required to, the bank is required to withhold tax. Means assessee that on behalf of withdrawal, assessee. Meaning the bank shall withhold tax on such withdrawal amount, which it shall deposit as a TDS, as a tax payment of the assessee. Though there is no income of the assessee in withdrawal. So therefore, it's a very unique section. Then why it is introduced? If there's no recovery, there should not be any recovery because there's no tax liability. And why it is introduced? It is introduced to track cash withdrawals. Government want to know who all are withdrawing a big amount of cash because we are moving towards less cash economy. So the Indian government wants a less cash transactions, and therefore it has limited the withdrawal. When we discuss this, we discuss in detail why 194N came. So if I just touch upon it, 194N actually came, is one of the reason was to curb the corruption as well. See, what happened is in the government is government department gives a contract to a contractor for say rupees 100 crores to build a bridge, to build a flyover, to build a road or something. Now we all know the government officials charge bribe to award this contract. But how will the contractor shall pay the bribe? The bribe is all paid in cash. But how will the contractor get the cash? Because the sum of 100 crore which he will get as a contractor for building the bridge or road, as the case may be, this 100 crore shall be paid by the government in his bank account. The government cannot pay cash for the services to the contractor. Government always pays the amount in the bank account. So to give a bribe, he has to withdraw cash. And therefore, now there is a tracking of the transaction, who all are people who are withdrawing big cash. Now the government, the department, that department may ask, why you withdraw such a big amount? You're getting a point? Even in the PGBP, any payment above 10,000 is disallowed. And if you're withdrawing crores of rupees, what are you doing with that? So if the government has the information, then it can ask the question. So 194N is not to recover the tax, but it is to track the transaction, to get the information. There are multiple reasons for which a provision might be used. You know, Mr. Manmohan Singh was awarded as a Manmohan Singh was he ex-Prime Minister of India, but before that he was our Finance Minister as well. I think in 91, year 91. And that year, 91 or 92, he was awarded as the best FM in the world. You know why? For a single in the world, for a single provision in the act. What he did, he introduced a single provision, section 80 IA, which gives a tax holiday to a person who set up an industry in backward area. So by an income tax provision, this Mr. Manmohan Singh could tackle the local crime, poverty, terrorism in that area. Because when the industrialists go, all these things actually fade away. These things happens only if the youth doesn't have a job. So once industry is set up, youth gets a job, this local crime and all is all very good. So with the help of income tax provision, you could solve the social problem. You understand? He doesn't use police or military or something to solve this problem. He uses income tax provisions. So income tax provisions are used for a variety of reasons. You just have to be creative. So 194N says is that if you withdraw payment in cash in excess of 1 crore, it's applicable only if the cash withdrawal exceeds 1 crore. I told you it's applicable only on big withdrawals. So who shall deduct tax? Any banking company, cooperative bank or post office. Who is the withdrawer? Any person, means including non-resident. Tax is deducted at the 2% if the sum withdrawal exceeds 1 crore, or in case of cooperative securities, the limit is 3 crore at time of payment. It also says if you have not furnished a return of 3 years, which 3 years? Whatever is the year of your withdrawal, say you withdraw in 25-26, then you leave 24-25, and we will see the 3 years before that, means 23-24, 22-23, 21-22. If you have not filed the return of these 3 years, then tax shall be deducted 2% on the amount exceeding rupees 20 lakh and 5% on the amount exceeding rupees 1 crore. 3 crore in case of cooperative societies. Do you understand this? Then comes section 194E. This section, the income referred to in this section, we studied in the last class only. This section is applicable on the income referred to in 115 BBA. If you remember, section 115 BBA applicable on non-resident, non-citizen sports person or sports association or entertainer. 115 BBA says that income of these three persons shall be taxable at the rate of 20%. And therefore 194E says the income referred to 115 BBA shall be subject to TDS. Who shall deduct TDS? Any person, whoever is paying the income. To whom? Non-resident sports person or entertainer who is not a citizen of India, or NR Sport Association, at the rate of 20% at time of payment of credit, whichever is earlier. Why 20%? Because the income in the hand of NR is also taxable at the rate of 20% only. Okay. Of course, this 20% shall be increased by surcharge and cess. Okay. An interesting question comes whether the umpires and referees can be classified as sports person. So the court held that they cannot be qualified as sports person. So 115 BBA and correspondingly 194E is not applicable on them. But court said that it's not that their income is not taxable. See, we discussed at the time of 115 BBA, since matches are held in India, the performance is held in India, the services are actually rendered in India, and therefore income accrued in India, and therefore such income is taxable in the hands of non-resident. Okay. And to give a relief, section 115 BBA was there, which covers specified types of income, advertisement, participation fees, and contribution to the of article to the newspaper sector. But it doesn't mean it only gives the tax rate in this respect of these three incomes, okay, of individual, of sports person. But it doesn't mean that if any income is not covered here, it's not taxable. If it is otherwise taxable under section 9, 4, 5, and 9, then the NR has to pay tax. If it's not under 115 BBA, then you pay the tax under normal provision. If there's no special rate, you pay the tax at the rate applicable to you. So, but the court said that if the match is held in India, then the amount so received by umpires or referee is accruing or rising in India, no doubt. But 115 BBA is not applicable, and therefore they will pay tax. They're taxable in the hands of this umpire and referee. They will pay tax under normal provision, and since they will pay tax under normal provision, the payer shall deduct tax under section. Come on. Under section 195 because they are non-resident. I told you, if there is no specific section, then tax shall be deducted under the general section, which is 195. You with me? What the note says, umpires and match referees can be described as professional or technical person who render professional or technical services, but they cannot be said to be either non-resident sportsmen, including an athlete, or non-resident sport association or institution, so as to attract the provision of section 115 BBA. And consequently, the provision of tax deduction at source under section 194E cannot be attracted. Clear? The payment made to non-resident umpire match referee in respect of games played in India. Okay? Since the games are played in India, these payments have become accruing or rising in India. Which has accrued or rise in India. Why? Because the matches, the game were played in India. The TDS provision under section 195 will be attracted and tax will be deductible at the rates info. You with me? Good. The next section 194T, the new member of the TDS family. So it says that TDS has to be deducted on any payment made by the firm to its partner, whether in the nature of salary, remuneration, commission, bonus, interest. Firm to a partner. Partner includes non-resident as well. Tax shall be deducted at the rate of 10% at the time of payment or pay, whichever is earlier, in the threshold of 20,000 rupees. You with me? So here we discuss the general section 195, which is applicable on payment made to NR if such payment are chargeable to income tax. Then we discuss some specific provisions which are applicable in case of NR as well, which are part of domestic tax TDS provisions, but applicable in case of NR as well. And we discuss that if such type of payment is being made to NR, then tax shall be deducted under these provisions and not under the general provisions. Okay. If you remember, section 195 said that any sum chargeable to tax other than salaries or interest under section 194 LB and LC. Now we will discuss what are this interest in section 194 LB or LC. So 194 LB and LC provides a concessional rate of interest if the interest is payable to non-resident. Why? Because Indian government wants the foreigners or foreign companies to lend money into India, to give money to India. And therefore, since this money is being lent to Indian, which is of course being used in the Indian business of this borrower, the interest so derived by the lender, though NR, is deemed to accrue or rise in India. We discussed this in section 9. And this interest is taxable in the hands of non-resident. To give them an incentive, the government has given a concessional rate. If you know, India has a lot of foreign debt. The government has taken a lot of foreign debt. If you see the budget, not now, you do it once you become a CA. If you have an interest, then you understand as an economy, as an Indian economy, where the money is coming from and where it is going. So this all things are there in the budget, which is presented every year. Every year, the finance minister gives an estimate and the actuals as well for the last year, an estimate for the next year, that from where we earn the income, where the money comes in to the India, and where it goes. So a big share of the outflow of cash is the interest expense. Now you know, and this a major share of this interest expense goes out to a non-resident, foreign companies, non-foreign governments. If you know, as we discussed, the interest payable by the government is always deemed to accrue or rise in India, and therefore this non-resident, whichever they are receiving interest from the government or from the Indian companies. Even the Indian companies borrow a lot of money from outside India, and is subject to tax in the hands of recipient, the lender, to encourage them so that they lend money to the Indian companies. The government has provided concessional tax rate. Concessional tax rate on this interest income which is received by the non-resident from Indian concern. So first section is section 194 LB. It is applicable if interest payable by infrastructure debt fund. So 194 LB is applicable if the payer of interest is infrastructure debt fund. If you have lent, you as an NR has lent a money to infrastructure debt fund, then the interest which you will receive shall be taxable at the rate of 5% in your hands. And even the infrastructure debt fund is required to withhold tax at the rate of 5% only. Okay. So 194 LB is a tax TDS section which provides TDS rate, and this interest is taxable under section 9 And the rate of this TDS is given in section 115A, which provides in case of TDS awarding for LB, the tax rate is 5%. So everything falls in place. You understand everything? So my section 9 makes this interest taxable. My section 115A says that it shall be taxable at the rate of 5%. And 194 LB says the payer shall deduct tax at the rate of 5%. So everything falls into the logic. Okay. Why benefit? Because this infrastructure debt fund, what they do, they invest the money into the infrastructure. See, we are a developing economy. We are a developing country. And we need a good infrastructure. Because of this infrastructure only, you and I are connected here. Because of this mobile infrastructure, that this telecommunication infrastructure, we are connected over through internet. So we need infrastructure in the form of road, airports, ports, bridges, telecommunication network, and all, because it helps in the growth of the economy. The rendering of service, the sale and purchase of goods, it becomes easy, and therefore the economy as a whole grows. So infrastructure is very important for any nation. So if you lend, if you means the non-resident lend money to infrastructure debt fund, the only purpose for which these funds are created is to build the infrastructure in India, then such income shall be taxable at the rate of 5% in the hand of such non-resident. 194 LC, very, very important section from practical point of view. It says interest payable on monies borrowed at any time before 1st July 23 in foreign currency from a source outside India under a loan agreement or by way of issue long-term bond, including long-term infrastructure bond, or by way of issue rupee denominated bond. We understand the meaning of rupee denominated bond. We discussed this in last class. Who is the payer? The Indian company or business trust. It means the Indian company has taken a loan in foreign currency or has issued a bond and received a money or has issued a rupee denominated bond. Then the Indian company shall be paying an interest, and such interest shall be taxable at the rate of 5%. And if the bond or RDB were issued after 1st July 2020 and before 1st July 23, and they are listed on the Economic Stock Exchange in IFSC, then they are taxable at the rate of 4%. Otherwise, the tax rate is only 5%, and this Indian company is required to deduct tax at the rate of 5% payment to NR or a foreign company. So again, a very, very concessional rate, only 5%. At this point, see, I tell you, this we all are studying from domestic tax, from the point of view of Income Tax Act. But if you know, a non-resident is eligible to apply the provision of Act or double taxation avoidance agreement, whichever is more beneficial to. So it might happen that an income is taxable in the Act, but if such income is exempt under the treaty, then such amount is not taxable because NR will invoke the treaty, which is beneficial to him. And therefore, in such case, Section 195 is not applicable. Why? Because 195 says sum chargeable to tax. Sum chargeable to tax has to be read, means sum chargeable tax read with Act and treaty. Even if the sum is chargeable tax under the Act but is exempt under treaty, then in nutshell, the amount is exempt because the non-resident is eligible to invoke the beneficial provision. And since the amount is exempt, Section 195 is not applicable. 195 doesn't come because sum doesn't remains to be chargeable. Are you with me? So when we apply 195, we see the Act, but at the same time, we also see the double taxation avoidance agreement. If there is some concession, some relief is provided under the double taxation avoidance agreement, then we deduct tax accordingly. Say, assuming the amount which the NR is deriving from India is taxable under the Act at the rate of say 20% royalty FTS, and such amount is taxable in the treaty. It's taxable in India as per the treaty, but the tax rate which is given in the treaty is say 10%. Then such amount is taxable actually at the rate of 10%, and non-resident shall be and the tax shall be withheld at the rate of 10% only under section 195. Whichever is more beneficial shall be applied, and 195 shall be invoked accordingly. So hope you understand. You're with me. So if you see in section 194 LB on LC, the tax rate is 5%, and this is the minimum tax rate. Even no DTA provides a rate lower than this. So this rate is provided in the Act itself. So it shall be applicable to all NR, whether there's a DTAA or not, whether DTAA provides a higher tax or not. So there's a minimum tax which is there in the DTAA. So there's a big relief for the non-resident, rather for the Indian company, because now they will get a easy money, because non-resident would be encouraged to lend money to the India. When you are a non-resident, you have many options. You can lend it to India or to all of the other developing countries. So you will weigh where you receive the more revenue with the lower risk. The risk is generally the risk of default and risk of depreciation in the foreign currency, of the currency of the country where you are lending the money. But the cost is tax is also a cost. You factor in that also. When you compare the proposals with India, there the tax cost is the minimum in the world in respect of these types of payment, which is 5%. Okay, so 194 LC apply if the Indian company borrows under loan agreement, or it receive a money by issue of long-term bond or rupee denominated bond. Okay, but see, it's apply only if the money was borrowed before 1st July 2023. It might happen that money was borrowed before 1st July 23 and still we are paying the interest. Therefore, 194 LC is relevant even now. It might happen that I might have borrowed in the year 2020 and I have borrowed for 10 years. Very normal. So I must be paying interest now as well. And such interest shall be taxable in the hands of non-resident at the rate of 5%. Because though interest is paid in 2025, but it is under loan agreement which was before 1st July 23. So the law says the loan agreement should be before 23. The interest payment may be subsequent to that. Okay? So that's why 194 LC is still relevant. 195. What it says? If any interest which is actually taxable in India and not covered above, then tax shall be deducted under section 195. I tell you, there are a lot of types of interest. A non-resident has made a deposit in bank. Then neither bank is an infrastructure debt company, debt fund, nor bank has actually borrowed a money. It's a deposit. So 94 LB and LC is not applicable. 25 shall applicable. It might happen that non-resident receives a refund of income tax from the Indian government and also receive interest on such refund. Then this interest shall be subject to TDS under section 195 only, because it's not taxable under section 194 LB or LC. Okay, very simple examples. Under section 194 LB and LC, tax shall be deducted at the time of credit or payment, whichever is earlier. Section 194 LC is applicable where the loan agreement and long-term bond are approved by the central government. Section 194 LC is applicable only to the extent to which such interest does not exceed the amount of interest calculated at the rate approved by the central government. It's basically theoretical points, but you need to remember them. But from practical point of view, they are theoretical because they are approved, they are allowed to lend money only if they are approved by the central government and the rate is approved by the central government. Okay, one more thing. Tax is deductible at the rate of 9% in respect of money borrowed by an Indian company or business trust from a source outside India by way of issue of any long-term bond or RDB on or after 1st July 23, which is listed on the recognized stock exchange located in IFS. So, if the money was borrowed by such Indian company before 1st July 23, the tax rate was 4%. After 1st July 23, then it's 4 plus 5 equal to 9%. Okay. You know, there's a provision section 206AA. What they say? They say that if the recipient does not provide its PAN, then tax is deducted at a higher rate. Okay. What is the relevance of date 1st July 2023? This is the date when the government feels that we have received a lot of loan. Now we don't want to extend this benefit to the further loan agreement. So this provision, I think, came into force from 2012 until the time 2023. The non-resident actually took a lot of benefit. Then in the budget of 2023, a sunset was provided where the no more further benefit was given to the future loan agreement. See, every provision has a life. If you see, I told you about Manmohan Singh, the ex-prime minister. He brought ATIA, but even now the ATIA has been sunsetted. There's a sunset clause. Once the provision achieves its objective, the sunset is provided because at the end, it's actually a cost for the government. Government's actually giving away its revenue in the form of tax. So when the government feels that we have achieved the objective, they provide a sunset date. So 1st July 23 was a sunset date for 194 LC. Okay. Now we were discussing 206AA. So 206AA provides that if the deductee, if the recipient does not provide its PAN to the deductor, then the deductor is obliged to deduct tax at the higher rate. You know all this. But if the recipient is a non-resident, then 206AA says that I will not apply to non-resident or foreign company deriving income of the nature of interest, FTS, royalty, or capital gain if he or it provides the following information. So, if non-resident or foreign company doesn't have a PAN, no problem. You give me these 4 information and I will not deduct tax at the higher rate. 206AA is not applicable. What are these information? See, what is the PAN required for? PAN is required for identification. So these 4 information only identify the non-resident so that if in future the government has to collect a tax from the non-resident, it can collect. It can catch hold of the non-resident. So it's actually the address of the non-resident for the Indian government. So what the non-resident is required to provide? Name, email ID, and contact number. Address in the country in which he is resident. His tax residency certificate, a certificate from the tax authority of such country where he is resident, certifying that he is a resident of this country. So I need a government certificate from your country. Tax identification number of deductee in the country of his residence. You don't have my PAN, no worries. You must be having some tax identification number in the country in which you are resident. Provide me that, so that in future I, through bilateral agreement, can catch hold of you. And if no such number is available, if there is no such number in your country, then any unique number allotted to you by the government of that country. Like here, there is Aadhaar in addition to PAN. If there is no such PAN in your country, then something similar to Aadhaar, give me that, which is unique. Okay. Okay. Now, we all have studied this in the last class only. If you remember, we discussed some special tax rates. So, the taxes were provided in those sections 115 AC, AD, AB, and all. The TDS on such income is provided in the section 196 A, B, C, and D. What does 196A says? Income from units of mutual fund. Director any person, recipient non-resident, tax shall be directed at 20%. Why? Because this income is taxable in the hands of NR at the rate of 20% only. Then 196B applies in respect of income referred to in 115AB. If you remember, 115AB applies on OFO, overseas financial organizations. So 115AB includes two types of income: income from units of mutual fund, or UTI purchasing foreign currency, or LTCG. And this income is taxable at 10% and LTCG at the rate of 20%. Similar is provided in the case of for the TDS 196B. Then this 194C, which is applicable in respect of income referred to 115AC, and 196D, which is applicable in respect of income referred to in 115AD. Okay. Tax shall be deducted at time of credit or payment, whichever is earlier. In case of units of mutual fund, 196A says that tax shall not be deducted in section 196A on any income payable to NRI or non-resident HUF, non-resident Indian or non-resident HUF in respect of units UTI, which were acquired from the UTI itself in NRE account maintained with any bank in India or by remitting foreign currency in accordance with the provisions of FEMA. So if NRI or non-resident HUF had actually acquired the units from the UTI itself in foreign currency or from the NRE account, then the income which they are deriving from such units shall not be subject to tax, and therefore no 196A. Similarly, 196D says that no tax shall be deducted in respect of income of specified fund. Why? Because such income is exempt under section 1040. Who is specified fund? We will discuss after the break. And income by way of capital gain arising from a transfer of securities referred to in section 115AD payable to FI. Why? Because this income is again not taxable. Okay. So this completes our TDS provisions which were applicable to a non-resident. So the baseline is at whatever income, at whatever rate is taxable in the hands of non-resident, it's subject to TDS at the same rate only. Okay. So we will have a small break of 10 minutes and then we will start with the next topic, exemptions. Okay. So let's have a break for 10 minutes. We'll again reassemble at 7:40. Okay, let's break. First half, the TDS provision specifically applicable to non-resident. The most important is Section 195, which is applicable on any sum payable to non-resident, which is chargeable under the Act. This shall be subject to TDS, and the payer, whether resident or a non-resident, is required to withhold tax. Okay. Then we discuss different sections, which are though are part of domestic TDS, but are still cover the non-resident recipient as well. Okay. Important one means includes 194 LB which is provides for 5% TDS rate on payment of interest to the non-resident, subject to the satisfaction of condition mentioned there. Now we are discussing exemptions. Exemptions available to the non-resident. See, first understand, exemption means at first place, had these exemptions not been there, this income must be taxable. So whatever we are discussing here, it would have been taxable in India in the absence of this exemption provision. Okay. So you will see all these incomes are actually taxable in India under the law, under the provisions which we have already discussed. Okay. Now, why exemptions are provided? See, these are taxable only, therefore the requirement of exemptions arises. Had they not been taxable at first place, then there is no requirement to exempt such income. It's not even taxable. So first, there must be a taxing right, a tax liability on such income. Therefore, the question of exemption arises. Exemptions arises. Okay. Secondly, why these exemptions are provided? Why? See, there is no free lunches in India, in the world. Indian government provide exemption. They forego their tax revenue because they want to encourage such types of dealing or transaction with the non-residents. This is in overall in favor of the economy of the country, and therefore they encourage the non-resident by exempting their income which they earn from India, so that they are encouraged to enter into these type of transactions, and therefore the exemptions are provided. Okay, simple. So what exemption? First, we'll deal with the exemption related to interest. Means the interest income which the non-resident of the foreign company is deriving from India is exempted. Is exempted from tax. So this interest income shall not be taxable, and correspondingly, the payer shall not be required to withhold tax on payment of such type of interest, which we will discuss. So first is interest on money standing at to the credit of individual in his NRE account with bank in India. If such individual is a person resident outside India as per FEMA, or is a person who has been permitted by the RBI to maintain such account. So what does it say? It says, assuming there is a person who has a NRE account, non-resident external account. What is this account? See, if you are a non-resident, then you can have two types of account in India: NRE, NRO. Your normal saving accounts are converted into NRE or NRO account. But the difference is that in case of NRE account, only foreign currency can be deposited. Money from foreign country can be deposited. If your NRO is normal, is your saving account, like you have a saving account. In case of NR, we call it NRO account. So, what the government wants? Government always want foreign currency in India, and so by nature, the NRE, the amount standing in the NRE account, it must be, has to be, it cannot be anything other than the foreign currency, because only foreign currencies can be deposited in NRE account. Whatever amount is there in the NRE account of an individual, such amount must be received, remitted to India in the form of foreign currency. Encourage these people to remit more and more foreign currency into India. But the government said that whatever interest you will earn on this account, I will not tax it. Had this section was not there, then this interest income must be taxable. Why? Because interest you receive from account, bank account in India. This income is accruing or rising in India. But government wants what the message to the non-resident is that you earn outside India, very good. You don't save into India. If you want to invest, if you want to make a deposit, you deposit in your NRE account. Not only that, the deposit in NRE account is exempt. The interest on deposit in NRE account is exempt, but even the FDs, fixed deposit made from such amount, is the interest on such fixed deposit is also exempt under this section. So what the government is saying? Government is saying you make your investment in your Indian bank account, NRE account, and whatever interest will you earn, that interest shall be exempt. I will not tax it. No, zero tax. Not even concession, zero tax. Provided the account is NRE account. The similar benefit is not given in case of NRO account. If there is a money lying in the NRO account and the interest is received in NRO account, the bank shall withhold tax. Can you tell me in which section? Bank shall withhold tax in which section in case of interest from NRO account? Simple. Section 195. 195. I think it's clear. So, if an NR has a NRE account or an RO account, then the interest whatever he earns on this NRE account is exempt. But is it exempt in the hands of individual who is a person resident outside India as per FEMA? So the law doesn't say that the person has to be non-resident, but the law says the person has to be resident outside India as per FEMA. Now what is this? See, FEMA, Foreign Exchange Management Act, also gives a definition of resident non-resident. But unlike Income Tax Act, what the Income Tax Act focuses on, if you see, the Income Tax Act focuses while deciding whether is a person resident or non-resident, it focuses on the stay, number of days the person stayed in India. On the other hand, the FEMA focuses on the intention. If the person has come back into India for permanent residency, then he will treat it as a resident under the FEMA law, irrespective of the stay in India in such year. If person may spend 2 years into India, but if he is not intended to permanently reside in India and his intention to go back, he will qualify as a person resident outside India under the FEMA law. So section 10.4.2 is applicable if the person is resident outside India as per the FEMA. Then any amount lying in his NRE account and the interest which he is earning on such amount is exempt under section 10.4. In case of joint account, if the account is joint, then joint account holders shall be entitled to exemption on satisfaction of the above condition by each of such joint account holder. Then they are entitled to exemption if each of them satisfy the condition, means each of them qualify as resident outside India as per FEMA and they earn the interest on their NRE account. If even one satisfy, then his part of his proportionate interest shall be exempt, and if both satisfy, then the interest shall be exempt in the hands of both of them. Okay. This is the first exemption qua interest. Applicable in the case of resident outside India, individual resident outside India as per FEMA. So any interest which they derive from their money lying in the NRE account. We are talking about NRE, non-resident external account. You understand why? So any such interest exempt from income tax. Second is interest payable by Indian company or business trust to a non-resident or a foreign company in respect of money borrowed from a source outside India by way of issue of RDB, rupee denoted bond, during the period from 1st 17th September 18 to 31st March 19. During this very limited period, from 17 September 18 to 31st March 19, if the Indian government has issued, Indian company or business has issued RDB, then the foreigner, the non-resident, who has subscribed to such RDB, and whatever interest they are deriving on this RDB shall be exempt. So this is as per section 10(4)(c). So this exemption is still valid because it might happen that RDB was issued during this period from 17 September 2018 to 31st March 2019. But the interest may be accruing, they may be active even now. Yeah. So this date is for the issue of RDB, as we discussed in the case of 94 LC. So this date is for the issue of RDB, not for the payment of interest. If the RDB was issued during this period and the interest is paid even now, then even now the interest shall be exempt in the hands of non-resident who had subscribed to these RDBs. Okay. Next exemption is provided under section 10(15). Income on deposit made by a foreign bank with a scheduled bank with the approval of RBI. If a foreign bank make a deposit with our bank, then the interest which such foreign bank is deriving is exempt. Then interest payable by a scheduled bank on deposit in foreign currency, where acceptance of such deposit is duly approved by the RBI. So if there is a non-resident or individual or HUF who is resident but not ordinary residents, RNOR, if they make a deposit in foreign currency in the scheduled bank, then also the interest to receive by them is exempt. Interest on deposit on or after 1st February 2005 in an offshore banking unit is exempt in the hands of non-resident or RNOR. Interest payable by a unit located in IFSC in respect of money borrowed by it on or after 1st September 19 to the non-resident is exempt. If there is any unit which is located in IFSC, what is IFSC? We'll discuss in a minute, today only, in detail. So if there is a unit in IFSC, IFSC is a, you can say, is a place in India which is treated as foreign. So if there is a unit located in IFSC, then if such unit has borrowed a money from the non-resident, then whatever interest that non-resident is deriving is exempt from such unit. Okay. These were some exemption related to interest. Now salary. If the non-resident is deriving salary from India, when he will derive salary? Generally when services are rendered in India. You with me? We discuss many a times. If services are rendered in India, then the salary in respect of this service is deemed to accrue or arise in India. And once the salaries accrue or arise in India, it is taxable in the hands of recipient irrespective of his residential status, because it becomes an Indian income, is taxable even in the hands of non-resident. So services rendered in India, and therefore the salary qualifies as income accrue or arise in India, and therefore it becomes a taxable in the hands of non-resident in India. So it's complete chain, one follows the other, because there is service rendered, and therefore since the service was rendered in India, therefore income is deemed to accrue or arise in India. Since the income is deemed to accrue in India, therefore it's taxable in the hands of non-resident as well. Okay, I think this must have been absorbed by you. We have discussed this many a time. With discussion, what happens is that you need not to remember things, and you apply the same logic to other provisions, and then you also appreciate why there's a difference and why it is similarity. If there's a difference, your mind asks why is the difference, and then you actually understand the logic. Okay. Okay. So we are talking about assumption related to salary income. So exemption there means the salary income at first place was taxable. What is the difference between exemption interest paid in NRE account and section 1015(4) exemption? So we're talking about if the non-resident Indian or the RNOR has invested money, has deposited money with the scheduled bank, then the interest which he is deriving is the money deposited in the foreign currency, and the interest which he is deriving is exempt under section 1015(4). Yeah, right. Earlier we discussed that 10.4.2, where it says that if the money is deposited in NRE account is exempt. So till that time, the NRE account was not there. If because it may take time to open the NRE accounts. If you deposit your money in a foreign currency and the deposits are approved by the RBI, then even if the account is not NRE, still the interest on such deposit can be claimed as exempt under section 1015. But here, two things is there. You need to prove that deposit are made in foreign currency, and such deposit has to be approved by the RBI. But in case of 10.4, the assumption is very straightforward. Whatever interest accrues in the NRE account is exempt. Nobody sees whether it's how the amount was deposited. Of course, it has to be deposited by foreign currency. There's no need to require the approval of RBI and all. Okay. So you don't need to apply your mind once you see NRE interest. You just claim it an exempt. But if otherwise you see an interest from scheduled bank, then it's very difficult to claim the assumption. Practically, I'm telling you, and section 1015, because you must have an approval from the RBI of such deposits. So we're talking about salary now. Come back. The salary says in all these cases, the salary income deriving by non-resident exempt, meaning thereby it was taxable at first place. What it says that individual assessee who are not citizens of India are entitled to the following exemptions. It's applicable to persons who are not a citizen of India. You need to be non-resident plus not a citizen. If you're a citizen plus non-resident, then the exemptions are not available. Then in such case, the salary income which you are driving is taxable. You understand the meaning of? Understand there's a difference between the words citizen and resident. The term citizenship generally means you have a passport. It generally derives from your birth. Resident, we understand how we compute it. It's a yearly concept. We need to compute depending upon the stay of such individual in India. So it may happen that Mr. A being a citizen of India and also NR, very, very much possible. He may be a citizen of India, he doesn't stay in India even for a single day. He settled outside India in US. There he's paying tax. So he will qualify as a citizen but non-resident. Then in such case, this person, this Mr. A, is not eligible for the exemption which we are studying now. For these exemptions, you must be not a citizen. You should not hold Indian passport. You should be Akshay Kumar. Akshay Kumar doesn't hold an Indian passport. He holds a Canadian passport. So, these exemptions are available to individuals who are not a citizen of India. First exemption is remuneration received by official or staff of an embassy, high commission, legation, commission, consulate, or trade representation of foreign state. Actually, in international law, we call country as a state. So India is recognized as a state. So we generally use the word foreign state, means a foreign country. In case of embassies and all, generally they are tax neutral, no taxes implied is levied in case of embassies and all. Even the GST, income tax, in both the cases, the exemptions are there. First amendment provide if the remuneration in respect of remuneration received by official staff of embassy. So there is a staff of embassy, and if you receiving embassy in India, embassy you may call it embassy, high commission, legation, consulate, trade representation, whatever name. They are just different names of the same thing. So very minute differences, not relevant for an exam point of view. So if there is a person who is working in the foreign embassies, the remuneration which he is receiving shall be exempt, provided the remuneration received by our corresponding government official staff in such foreign countries is exempt. It's quid pro quo. What it says, you exempt my people, I will exempt your people. So what the government says, if my person is employed in your country, in the embassy, and if you don't tax him, then I will not tax the people which are employed in your embassy. India must be having an embassy in US. US is also having an embassy in India. If US doesn't tax the person working in the Indian embassy in US, then even India will not tax the person working in US embassy. Clear? So quid pro quo. You give me relief, I give you relief. You tax me, I tax you. Okay. Above mentioned official staff is not engaged in any other business, profession, or employment in India. And such staff should be exclusively working for the embassy. They should not be engaged in any other business, profession, or salary income in India, or they should not be having any source or revenue from India. Okay. So the remuneration received by the staff of an embassy is exempt. See, the requirement is this staff should not be a citizen of India. He should not be citizen. There is no requirement that this staff should also be a non-resident. Because see, this person is working throughout, he's staying in India throughout as an employee of the embassy. So he most probably would qualify as resident. But still, since he's working in the embassy, the exemption is provided because the government generally don't tax the embassies or different countries. But India says, I will not tax you only if you don't tax me. So there has to be quid pro quo. The condition of the exemption is only you have to prove that your country is not taxing the people working in my embassies. Clear? B. This is very important. This will be very helpful as well in your practice as well. Remuneration received for services rendered in India as employee of foreign enterprise if in the first case the employee was of embassies. So very limited applicability in practical scenario. But here the employee is working for foreign enterprise, for a foreign company, for any foreign company. But the service is rendered in India. So you may be an employee of a Microsoft Inc., but you have rendered a service in India. Then the remuneration which you derive from such service, from rendition of such service, while you was in India, shall be exempt if the foreign enterprise is not engaged in any business or trade in India. Such foreign enterprise should not be engaged in any business in India. It's a business in India. It may do business with India, but it should not do business in India. Now you will say Microsoft is doing a business in India. No. I am saying I am an employee of Microsoft US. Microsoft US has a subsidiary in India, Microsoft India, which is doing a business in India. But the business of Microsoft India is not the business of Microsoft US. The business of a company is not the business of a shareholder. Shareholder and a company are separate legal entities, a separate person. Yeah. So I am not an employee of a Microsoft India. I'm an employee of Microsoft Inc. And Microsoft Inc. should not be doing any business in India. Okay. The employee stay in India does not exceed 90 days in the previous year. Exemption is provided only if you stay in India for 3 months, 90 days. If you exceed this limit, then the entire salary which you derive for service rendered in India shall be taxed. Once you exceed the 90 days limit, then the exemption is not there. Exemption is forward. Exemption is provided for a limited stay period, which is 90 days. Similar period is also provided in the DTAA, most of DTAA as well. The remuneration is not liable to deduct it from the employer's income chargeable to tax under that. If there is some income chargeable tax under that of the employer of the Microsoft Inc., then this remuneration which you are driving for service rendered in India should not be claimed as a deduction from the while compared to the Indian income. See, the enterprise is not doing a business in India, so it will not have a business income. But if for a case there is any other income which for which the foreign enterprise is liable to pay tax in India, then the remuneration so paid by it should not be deducted from such income. Okay, it might happen that the foreign enterprise may be providing FTS or royalty which are taxable on gross basis. Then, and for this, and he also has an employee which has rendered service while he was in India. So the salary which this employee derives from the company shall not be taxable in India if the foreign company is not doing business in India. They are not doing business in India. They don't have PE, permanent establishment, not a business connection. When I say business in India, I mean business connection or PE. The employee which we are talking about stay in India for not more than 90 days. His stay in India is only 90 days or less. And the remuneration which this employee is deriving is not liable to be deducted while comparing the Indian taxable. It might happen that the employee of Microsoft Inc. happens to be in India for a month or 30 days. So he provides services while he was in India for 30 days and receive a salary income. This salary income is accruing or arising in India and therefore taxable in India in that because the services in respect of this salary received was rendered in India. But this will create a huge problem because this foreign company normally sends the people in India to oversee their subsidiary or to whatever thing. So an exemption is provided which says if the Microsoft Inc., if the foreign company is not doing any business, it must not do any business in India. So they must not be having any business connection or permanent establishment in India. The stay of this employee should be less than equal to 90 days. If you stay more than 90 days, then the exemption is gone. And if there is any income of Microsoft Inc. which is taxable in India, then while computing this income, the Indian income, we are not talking about the foreign income, the income which the Microsoft Inc. is required to compute in its home jurisdiction. We are talking about the Indian taxable income of Microsoft Inc. While computing this Indian income, the Microsoft Inc. should not claim the deduction of the salary paid to this individual. If all these three conditions satisfied, then the salary so received is exempt in the hands of individual. Clear? If you see again, there is no condition that the individual should be non-resident. Now there is a condition in third part. Salary received by a non-resident for services rendered in connection with employment on foreign ship, with total stay in India does not exceed 90 days during the previous year. So if there is a person who is non-resident plus not a citizen, you understand? The requirement that you should not be a citizen of India applies in all these clauses. But in C clause, it is specifically written that you should not be non-resident as well. So in first and two clause, it is sufficient if you happen to be not a citizen of India. Even though you may be a resident, no worries. If you satisfy other conditions. But the third exemption is available only if you're not a citizen and also non-resident in India. Then, and you're rendering service to a foreign ship. You are employed by a foreign ship. Then it might happen that foreign ship stays in territorial water in India and therefore you stay in India, then in such case, the remuneration which you derive shall not be taxable if your stay is in India does not exceed 90 days. The similar period which was referred above. Last assumption, remuneration received by employees of foreign government from their respective government during their stay in India. Yeah, good one. So, foreign government employees are coming into India. If such remuneration is received in connection with their training in any establishment or office or in an undertaking owned by the government company or subsidiary, statutory corporation or any society which is wholly financed by the government. So what this clause is, there are employees of foreign government who are visiting India to give training to the Indian government employees, the government employees of India. So while they give a training in India, they actually render service in India. Okay. So for which whatever amount they will receive in their home country shall not be taxable in India. You with me? I know, because without the assumption, such amount should be taxable in India, and the foreign government was even required to withhold tax under Section 192. But this is important for Indian government employees to have an international exposure. So the government has given an exemption. If any government employee of the foreign country visits India to give training to my government employees, then whatever amount he is receiving in his home country or in India, whatever, it shall be exempt. Okay, you with me? So, 4 types of exemption provided in case of salary. First, employees of the embassies, quid pro quo. Second, important one, the employees of a foreign enterprise. If foreign enterprise is not doing any business in India, the stay is up to 90 days. And lastly, the remuneration which is being paid to this employee is not deductible against the Indian taxable income of such foreign enterprise, if any. Third exemption, non-resident, non-citizen employees of foreign ship, if they stay in India, is up to 90 days. And lastly, employees of foreign government which have been deputed to India for training to Indian government. You with me? No? Let's see some examples. Mr. A citizen of India but resident of USA, since year 2012, was appointed as senior official of the US Embassy in India. Okay, we're talking about he's a employee of the US Embassy in India. He earned, so this income is exempt if similar exemption is provided by the US to the Indian embassies employees. He earned a remuneration of 10 lakh during previous year 25-26. Being an individual who is a citizen of India, though fulfilling other conditions of the section, such remuneration shall not be exempt in his end for AY 26-27. Shall not be exempt only if such a similar exemption is not provided to Indian embassies. Mr. Vikram Kohli, an Indian-born person but country resident and citizen of USA. Okay, in first case, not exempt also because he's a citizen of India. The exemption is provided only to a person who is not a citizen of India. The important point is this, not that Indian embassies are exempt or not. Even if Indian embassies are exempt, still the salaries, Mr. is not eligible for the exemption because he is a citizen of India. An exemption provided only to the person who is not a citizen of India. So Mr. Vikram Kohli, another example, an Indian-born person but currently a resident and citizen of USA, was appointed as a senior official of the US Embassy in India. Okay. He earned remuneration of 10 lakh during 25-26, being an individual who is not a citizen of India and also fulfilling other conditions of the section. Such remuneration shall be exempt. What's the difference between point 1 and point 2? In point 1, he was a citizen, therefore not eligible for the exemption. In point 2, he's not a citizen and therefore eligible for the exemption. Okay? Because I told you, In all these four cases, the common requirement is the individual should not be a citizen of India. Had it been a citizen of India, then these four exemptions is not available. So in first case, Mr. A was citizen of India and all the things same, therefore not eligible for exemption. In second case, Mr. Vikram Kohli was not a citizen of India, he was a citizen of USA. Though he was born in India, but no worry, he became a citizen of USA. I need to see the citizenship, not the person of Indian origin. So though he might be a person of Indian origin, but he is not a citizen of India, and therefore he is eligible for the exemption. Mr. Frank D'Souza, an Irish citizen but currently the resident of USA, so is not a citizen of India, was appointed as senior official of US Embassy in India. He earned a remuneration of 10 lakh during financial year 25-26. Being an individual who is not a citizen of India, such remuneration shall be exempt in his hand. Similar, subject to the fulfillment of condition. I am not required that the person should be citizen of the same country of which the embassy he is working in the embassy. The only requirement is he should not be a citizen of India. He might be a citizen of any other country. Lastly, Mr. A, he is a citizen of India but resident of USA since the year 2012, was appointed in India in October 2024 as an employee of a US enterprise. Okay. Such US enterprise not engaged in any business in India. Okay. A's job require him to visit his US office every 25 days for the reporting purpose. Okay. During FY 25-26, Mr. A earned a remuneration of 10 lakh for his India related assignment, and his stay in India in aggregate was 85 days. See, he's satisfying the condition. His stay is less than 90 days. He is an employee of foreign enterprise. The foreign enterprise is not engaged in a business in India. Further, such US enterprise has not claimed any deduction of such remuneration under the Income Tax Act. And even the foreign enterprise has not claimed the deduction of remuneration which it is paying to Mr. A against its Indian taxable income. But being an individual citizen of India, such remuneration shall not be exempt, though he is satisfying all these three conditions. He is an employee of foreign enterprise which is not doing any business in India. His stay in India is less than 90 days, and the foreign enterprise not claiming deduction of this salary against its Indian taxable income. But still, this exemption is not available to him because he is a citizen of India. These types of questions are generally asked in case of as a part of MCQs. So take it, either you get the full marks or you don't get the full marks. There is no midway. Take it or leave it. So what it says, being an individual citizen of India, such remuneration shall not be exempt in his hands for AY 26-27 under the section 10.6.6. Though he may get the exemption under any other provision of the Act subject to fulfillment condition, it's not eligible for exemption under this section. In the above case, let's consider that Mr. A is a citizen of USA. Everything changes. If he's a citizen of USA, he was even otherwise fulfilling the other conditions. The only condition because of which the exemption was denied was he was a citizen of India. Now, since he's a citizen of USA, all other facts remaining same, his exemption shall be exempt. Now, all the checkbox has been ticked. So, his exemption shall be exempt for AY 26-27 under this section. Let's take another variation. Mr. A is a citizen of USA, but the remuneration paid to him is borne by PE of such US enterprise in India. See, where it says that Mr. A is working is an employee of a US company, foreign enterprise, but this US company has a PE in India. What do you mean by PE? PE means permanent establishment. It is similar to what we studied, business connection. So when you say a company, a foreign company has a business connection or PE in India, it means, what do you mean by business connection? It means the company is actually doing a part of its business in India. You understood? Once you have a business connection means you are doing business in India. Or similarly, like there's a concept of business connection under the Act, there's similar concept of PE, permanent establishment, under the treaty. So if you have a treaty, you qualify, you constitute a PE in India, then you are doing a business in India. And once you are doing a business in India, then the exemption is not available because there are three conditions. Out of four, you should not be a citizen of India. The foreign enterprise should not be doing any business in India. And this is important. You have you have reached this condition. And thirdly, your stay should be less than 90 days, up to 90 days. And lastly, the remuneration which is being paid should not be claimed as deduction against the Indian taxable income. Here, the second condition that business in India is not satisfied till now. So Mr. A is a citizen of USA, but the remuneration paid to him is borne by PE of such US enterprise in India. 10 lakh paid to A is cross-charged by US enterprise to its Indian PE. In this case, the remuneration shall not be exempt. See, it's cross-charged to the Indian PE, meaning thereby the Indian PE must be paying tax on Indian income on net basis, and since the salary has been cross-charged to it, it will be claiming the salary as a deduction while computing is Indian taxable income. So even the third condition is not satisfied. In this case, the remuneration shall not be exempt from taxation in the hands of Mr. A, and the same is getting deducted from the income of Indian PE of such foreign enterprise. So I told you this is the important section, and therefore it might be asked in the exam as a part of MCQ or a small question. There's no quid pro quo. See, the condition of quid pro quo is for the embassies. For in other case, if you're an employee of a foreign enterprise, foreign company, then you have to fulfill the three conditions, Sanjay ji. First is, of course, the common is you should not be a citizen, not a citizen. Then this is the common condition. Then other three conditions are the foreign enterprise of which you employ should not be doing any business in India. Then your stay should be less than equal to 90 days in India. And lastly, the salary which you are deriving while for your services in India should not be claimed as deduction against the Indian taxable income of foreign enterprise. So if these conditions, all of these conditions are satisfied, then only the remuneration which you are deriving for services rendered in India is exempt. And similar conditions are there in the DTL as well. Okay. The condition of quid pro quo is only for employee of the embassies. Okay. Though practically, if I tell you the similar condition, when I say the similar condition there in DTL, and DTL is applicable for both the country. So generally there is a quid pro quo. The similar conditions are there for the other country as well. If there is a Indian citizen who is working in USA for a Indian company and it stays less than 90 days in the USA, then his salary is not taxable in the USA. It's taxable only in the India. Okay, but the domestic law provides a quid pro quo only for embassy employees. In respect of your employee of foreign company, you need to fulfill these four conditions, and if all these conditions are satisfied, then the remuneration is not taxable. If even a single condition is not satisfied, then the remuneration is taxable. Okay. Now, lastly, exemption, not the last one, but the major one related to IFSC. What is this IFSC? IFSC is Integrated Financial Service Center. Financial Service Center. You treat this as a onshore offshore unit. Onshore offshore means they are actually within India but treated as a part of foreign land. Okay. So what happened is, if you know, some years back, Singapore used to be considered as a financial hub of Asia, meaning thereby, you know, like in India, Mumbai is generally considered as a financial hub of India. Most of the head office of banks, the big banks, are being located in Mumbai. Right. Similarly, if you see from Asia perspective, the Singapore was considered to be the financial hub for Asia Pacific region of each company. So when I say financial hub, it includes bank, insurance, and then investment funds as well. So most of these FIIs, FPIs, AIF, the foreign institutional investor, foreign portfolio investor, alternate investment funds, all these funds, most of these funds were being based out of Singapore. Why? Because the regulatory and tax structure of the Singapore was such that it used to favor this type of financial companies, financial institutions. And what these financial institutions used to do, their major investment was in India, because India is a very big market in Asia. Even the Indian money was invested as a into the FIIs registered with the Singapore authority, and then invested into India as part of FII from such. So India used to subscribe in the HNIs of India used to subscribe to the units of FIIs which are based out of Singapore, and these FII then again used to invest into Indian shares. So what the Indian government thought is not right. We are losing a lot of tax and control over my own money because of my tax and regulatory provisions. So my tax and regulatory provisions are such that these funds, these banks, these international banks, the international insurance companies are not inclined to set up their base in India because they have to pay a lot of tax, and I'm not tax friendly for them. And while they are in Singapore, they get a lot of tax exemptions, and therefore they set up their base for Asia Pacific region in Singapore. So to encourage them, to bring them back to India, the Indian government brings the concepts of IFSC. So this is a place, a designated area in Gujarat, in Gandhinagar city, which is being treated, though it's within the Indian jurisdictional area, in Indian land, for tax and regulatory purposes treated as outside India. It's not treated as India. We will see it has a lot of exemptions which are available in respect of financial intermediaries, banks, insurance company being working from there. Yeah. The exemption provided so that these foreign FIIs, funds, banks can actually come into India. Yeah. Though we are not receiving tax because a lot of exemptions there, but we have a control over the money. Yeah. We are being known. We are now substitute of the Singapore. Okay. So there is only one IFSC is there till now in India. It's in Gandhinagar in Gujarat. So this Gandhinagar is also known as, this IFSC is known as Gift City. Gift City. To understand why IFSC was, the concept of IFSC was brought in, it was brought in to give a level playing field to the international financial institution so that they can operate from India. So it's actually a land in India which is treated as a foreign. Okay. So a lot of exemptions are provided. Firstly, it says that if there's any specified fund which is there in IFSC, practically all income of such specified fund is exempt. So what section 1040 says? 1040 says that following income accruing or arising to or received by a specified one fund would be exempt. What are these income? Any income from transfer of capital asset. So we're talking about capital gain. Being a bond of an Indian company or a public sector company, JDR, repeat denoted bond RDB of Indian company, or derivative of any other notified security on a recognized stock exchange located in IFSC. So there is a recognized stock exchange in IFSC where the shares are traded in foreign currency. And the consideration is paid or payable in convertible foreign exchange. So though IFSC is in India, but there the financial dealings are happening not in INR, but in the foreign currency. So I told you it's actually a foreign land within India. For all tax and regulatory purposes, treated as a foreign land in India. So it is a recognized stock exchange. If the specified fund earns a capital gain on transfer of bonds of Indian company or public sector company, GDR, repeat denoted bond, or derivative, or any other notified security, if such security is being transferred on a stock exchange in the IFSC, and the consideration is paid or payable in the foreign currency, then such capital gain is exempt in the hands of specified one. And the exemption is any income from transfer of securities other than shares in a company resident in India, or any income from securities issued by non-resident and where such income otherwise does not accrue or arise in India, any income from securitization trust which is chargeable under that PGB. To the extent such income accrued or arisen to or received or attributable to units held by non-resident or is attributable to investment division of offshore banking unit as the case may be concluded in the prescribed manner. It says these four income of the specified fund shall be exempt only if such income is attributable to the units held by non-resident. Actually, primarily all the units of a specified funds are held by the non-resident, except the units held by its manager or sponsor. There may be a manager or sponsor of this fund. He might be a resident. So he may have some units in this specified fund, except the units held by its manager and sponsor. All the units are required to be held by non-resident only. And the income which the specified fund is driving shall be exempt under section 1040. There is a very small exception. What the law says, I require that all the units except the units held by manager to be held by the non-resident. But there may be a case that at a time of acquisition of unit, the person was an NR. Okay, fine. But subsequently, once the unit has been acquired by him in the specified one, he becomes resident. Then it is fine, no worries, provided all the units held by all this type of resident who was NR at the time of acquisition of such unit should not exceed 5%. Okay. So primarily the units held by specified ones are non-resident, by the non-resident only. Now the law explains what is specified fund. The specified funds means a fund established or incorporated in India in the form of a trust or a company, LLP, or body corporate as the case may be, which has been granted certificate of registration as category 3 alternate investment fund. So it's a category 3 AIF and is regulated under the SEBI Alternate Investment Fund Regulation 2012, made under SEBI Act 1992, or regulated under the IFSC Authority Regulation 2022, or may under IFSC Authority Act. So specified fund means a fund incorporated in India and registered with SEBI as category 3 AIF. which has been granted certificate as a retail scheme or an exchange traded fund and satisfy the conditions laid down for such scheme of fund under the IFSC authority recommendation. Okay, it's either the category 3 AIF registered with the SEBI or it's a retail scheme or ETF. It has to be located in IFSC. Located any IFSC means currently there is only one IFSC in India, of which all the units are held by non-resident. A fund shall qualify as specified fund only if all of its units are held by NR, other than units held by sponsor or manager. Exception is given. However, this condition will not apply. Condition that all the units should be held by NR shall not apply where any unit holder being non-resident during the previous year when such unit or units were issued becomes resident in the previous year subsequent to that year. So the holder was actually an NR at the time of when he acquired the unit, when the units were issued to him. But subsequently he becomes resident. It might happen. Then also the fund shall continue to be qualified as specified fund even if all the units are not held by NR, provided aggregate value and number of the units by such resident. Such resident means resident who were NR at the time of issue do not exceed 5% of the total units issued and fulfill such other conditions as may be prescribed. So within the IFSC exemption provided in respect of IFSC, this is the most important exemption which is provided to the specified fund. Okay, so it exempts the capital gain and other income of the specified funds. The income is exempted only to the extent is attributable to the NR unit holder. Specified fund means a fund who is either a category 3 AIF registered with the SEBI or a retail scheme or an ETF. It must be located in IFSC and all of its units must be held by NR except the units held by manager or sponsor. There's only one exemption. The units are issued to NR, but subsequently such NR becomes R. Then also exemption shall not be withdrawn, shall continue, provided the units held by these types of residents are up to 5% of the total units. Okay. Specified fund also includes means an investment division of offshore banking unit. So there is a foreign bank which has an investment division in India in the IFSC, which has been granted certificate of registration as category 1 FPI, category 1 foreign portfolio investor, under SEBI regulation made under SEBI Act and which has commenced its operation on or before 31st March 2030. So, if the foreign bank opens up investment unit in IFSC, get it registered as category 1 FPI before 2030, then also the income of such unit, investment unit, shall be exempt under this section. Such investment unit shall qualify as specified fund. Fulfill such other condition including maintain a separate account for its investment division as may prescribe. Okay. So this was the exemption available to a specified fund or which is located in IFSC. Now there is some corresponding exemption available to the unit holder of this fund. See, 1023 FBC. It says income accruing or arising to or received by a unit holder from a specified fund or on transfer of unit in a specified fund shall be exempt. Any income accruing or arising to or received by unit holder from a specified fund or on transfer of unit in specified fund will be exempt. So earlier they exempt the income of specified fund, and in this section they exempt the income of a unit holder, the non-resident unit holder of this specified fund as well. So got it? A big relief to the specified fund and its unit holder. Next exemption 104E. Any income accrued or arisen to or received by non-resident as a result of transfer of non-deliverable forward contract. Non-deliverable forward contract means The forward contract is a concept of a family stock exchange. There's a forward and options contracts. They're non-deliverable forward contracts. Means you have to settle by paying the difference or receiving the difference. Or offshore derivative instrument or over-the-counter derivative. Over-the-counter derivative means it's not traded in the stock exchange. It's between the two parties, privately placed, over-the-counter, OTC. Or distribution of income on offshore derivative instrument or over-the-counter derivative and enter into with offshore banking unit of an IFSC or any foreign portfolio investor being a unit of IFSC which fulfill prescribed condition would be exempt. So any income of this offshore banking unit or FPI from these transactions is exempt if they are located in IFSC. Okay. And then the benefit is given to the persons, to the companies who is into the commercial leasing of ships and aircraft. This is also a very important financial business globally. Yeah. Very big companies are involved. Yeah. Because you understand, the asset is of thousands of crores. Yeah. Ships and aircraft are very big assets. So what these companies do, they own these assets and they give it on a lease to the airline or shipping companies and receive the lease rentals. It's a very heavy capital intensive business. Income of non-resident by way of royalty or interest on account of lease of aircraft or ship in a previous year paid by a unit of an IFSC referred to in section 80LA if the unit has commenced its operation on or before 2030, 31st March 2030 would be exempt. Okay. Then income received by non-resident from portfolio of securities. So what the unit in IFSC is doing, they are managing portfolios. They are providing portfolio management services. So income received by non-resident from portfolio of securities or financial products or funds managed or administered by any portfolio manager on behalf of such non-resident, meaning portfolio management services, or such activity carried out by such person as may notified by central government in any account maintained with an offshore banking unit in any IFSC would be exempt to the extent income accrues or arise outside India is not deemed to accrue or arise. Okay. So there is an offshore banking unit providing foreign portfolio service, then the income from such service exempt. Any income of non-resident or unit of IFSC engaged primarily in the business of leasing of aircraft or ship by way of capital gain. So earlier they exempt the interest or the royalty income. Now they are exempting the capital gain on transfer of equity shares of domestic company being a unit of IFSC. Engaged primarily in the business of lease of aircraft or ship which has commenced operation before 31st March 2030. So if they are selling the share of their subsidiaries, and also the income which they are deriving from selling the shares shall be exempt. The exemption is provided up to 10 years. So what it says, the exemption of capital gain on transfer of equity share of such domestic company is available for a period of 10 assessment years, starting from the year in which the company was commenced operation, or if there's an old company, then up to 34 for 10 years. Now, if you remember, we in the last class discussed about the presumptive taxation of cruise ship. If you remember, the presumptive rate was 20%. It says any income of foreign company from lease rental of cruise ship. So now the company is engaged into the leasing of cruise ship received from specified company which operates such ship in India will be exempt. The income will be exempt where such foreign company and a specified company are subsidiary of the same holding company and such income received or accrued or arise in India for any assessment year before first applied 2030. The exemption is up to 2030. For the time being, the sunset is provided up to 2030. When we come to close to a date, generally it gets extended depending upon what was the objective and how much it is achieved. Specified company means a company other than domestic company which operates cruise ship in India and opts to tax in accordance with the provision section 44 BBC, the same section which we discussed in the last class. 20% presumptive rate. This we have studied. Now, two small exemptions. 1023 FF. You don't need to remember the section, just remember the provisions. Again, assumption by to non-resident specified fund. From the income in the respect of income of capital gain on account of transfer of share of a company resident in India by the fund to the extent attributable to units held by the non-resident. Similar, which we discuss in 10.4b. And such share were transferred from the original fund or from its wholly owned special purpose vehicle to the resultant fund in reallocation, and where capital gain on such share were not chargeable tax if that relocation had not taken place. This is very important section. Important not from exam, but important because here they are providing assumption if a fund relocate from some other part of the world to IFSC. So this is to encourage the funds which are already set up in Singapore to come to India. And on account of this relocation, if they earn any capital gain, we will provide the exemption. Lastly, any income by way of dividend from a company being a unit of any IFSC primarily engaged in the business of leasing of aircraft or ship. Okay. Another exemptions are provided for royalty income. They are also in respect of royalty of aircrafts and all. So, if the first assumption is tax paid by the Indian company engaged in the business of operation of aircraft which has acquired an aircraft from or an aircraft engine on lease under an approved agreement entered into between this and this date or after 31st March 2007 on lease or rental or income derived by the government of foreign state or foreign enterprise. So what's he saying? There is a company which has taken on lease the aircraft or aircraft engine, and it is giving lease rental to the foreign government or the foreign company. These lease rental are not exempt in the hands of foreign government or foreign company. But if the Indian company is also bearing the tax on these lease rental, then this tax amount is not taxable in the hands of the recipient. Understood? So, if the Indian company is paying 100 rupees and say there is a tax of rupees 10 on this, so which is also being borne by the Indian company. So, actually, the income of the foreign company is 110 because tax is also borne by the Indian company. Then the income, for computing the income, we have to gross up. Then the section 10.6BB exempt this 10 rupees tax paid in the hand. This tax is exempt in the hands of foreign company. Royalty income or FTS under an agreement with the central government for providing services in or outside India in projects connected with the security of India. If any royalty or FTS is being paid by the government to the foreign company, and such royalty and FTS is paid in connection with any security project of India, then such income shall be exempt in the hands of foreign company. Okay. So royalty income from or FTS rendered in or outside India to the NTRO, National Technical Research Organization. So if any NTRO, National Technical Research Organization, gives any royalty or FTS to any non-resident or foreign company, then such royalty or FTS exempt in the hands of such non-resident foreign company. Of course, is to give an advantage so that India receive a technical research or technical knowledge. Lease rental paid by Indian company engaged in the business of operation of aircraft to acquire an aircraft or aircraft engine on lease under an agreement not entered between it or after it. Okay, so here the lease rental exempt. Now miscellaneous exemption provided to non-resident. In this, one of the exemption is provided to the Abu Dhabi Investment Authority. If you remember 2 or 3 or 4 years back, Mr. Modi made a visit to the Saudi Arabian countries. And the visit was to convince them so that they invest in India. They have a lot of money, so they invest in India, Indian stock markets, Indian exchanges, Indian bond, debenture. And to make them convince a lot of tax benefit is given. So, the benefit is given by way of section 1023 FE. So it says any income of a specified person. Specified person means Abu Dhabi Investment Authority. In the nature of dividend, interest, any sum referred to in section 56 to 7 instead of business trust or LTCG. So all such income which arises from the investments shall be exempt, which are they arising from investment made by it in India, whether in the form of debt or share capital or unit. So whether they invest in the debentures or loans, whether they give the money into the share market, or whether they invest in the mutual fund. So whatever income they are deriving, whether the capital gain or their interest or dividends, if the investment is made after 1st April 2020 but before 2030 and is held for at least 3 years, then all such income shall be exempt in the hands of this Abu Dhabi Investment Authority. Eligible investment should be the see what where I want the investment. I want the investment in my infrastructure. I want to improve the infrastructure of India. So the benefit is given only if the investment is made into the infrastructure. Eligible investment should be in the business trust or company or enterprise or entity carrying on the business of developing or operating and maintaining or developing, operating and maintaining infrastructure facility. So you give a loan to the company which is engaged in infrastructure facility, either developing and maintaining. You purchase the shares of a company who are actually doing infrastructure facilities in India. You purchase a share of mutual fund who are investing in these types of companies. Okay. Or you make an investment in category 1 or category 2 AIF having not less than 50% investment in one or more of the company or enterprise or entity referred to in B above or infrastructure investment trust. So you understand whether you invest directly into the company which are actually engaged in developing infrastructure facilities in India, or you invest in funds which are in turn investing in these types of companies. So you will be exempt from whatever types of income you derive from your investment in India. Or you invest in a domestic company having minimum 75% investment in one or more of the companies or enterprise or entities referred to in BMO. So you invest directly into the company which are doing this, you invest in their holding companies. Or you invest in the NBFC, which are or infrastructure debt fund, as referred to in this, having minimum 90% lending to one or more of the company or enterprise referred to in B. You invest in NBFCs, which are actually only financing these infrastructure projects. Okay, so the exemption is available of all these income from which you may derive from your investment in India. You mean the Abu Dhabi Investment Authority. If you make an investment for the development of infrastructure in India, understood? Whether you directly invest into such company who are engaged into this, or you invest into the funds which are inter-investing to this company, you invest in the holding companies of this company because money will flow to them only, or you invest in the NBFCs which are actually financing the project of these companies. Yeah. So lastly, there's some small exemptions now left. Income of European Economic Community is being exempt. Income in the nature of interest, dividend, capital gain. Income of SARC fund for regional projects set up by Colombo Declaration is exempt. Income received in India in Indian currency on account of sale of crude oil. If a foreign company is selling a crude oil, this is important community for us. If you remember, if you know, not remember, if you have read the newspaper, the US has very recently attacked on Venezuela. And they are saying that one of the reason of the attack, one of the hidden reason is that Venezuela has a lot of oil reserves. So oil is a very important community, for the world. So it says if the foreign company is selling a crude oil in India, we don't have much of oil. We are depending upon the foreign countries. There are a lot of import of crude oil in India. So if the foreign company is selling a crude oil in India, then the income of such foreign company shall be exempt from this activity. To any person in India, foreign company agreement should be notified by the central government. The agreement should be notified. Lastly, if a foreign company is storing crude oil and now from that storage he is selling the crude oil. Income accruing or arising on account of storage of crude oil in a facility in India and sale of crude therefrom to any person resident in India, then the income from these activities in India shall be exempt in the hands of foreign company, provided they are under an agreement notified by the central government in the national interest. 1048B says once this agreement is over, is expired, it may happen that agreement is expired on this day and still there is a stock of crude oil lying in India. So once you sell this stock, you're not covered by the exemption section 1048A because the agreement has expired. But then the exemption is provided under section 1048B. It says income from sale of leftover stock of crude oil from facility in India after the expiry of the agreement referred to in section 1048A or on termination of said agreement in accordance with the term mentioned therein, subject to such condition as notified by the central government. So till the time the agreement is in force, the exemption is available under section 1048A. Once the agreement expires, the exemption is available only in respect of the leftover stock which was there once the agreement expired. For this, if you sell those leftover stock, then also you will not be taxed in India. Had the exemption was not there, 1048, 48, 48B, this foreign company would have constituted business connection and would be liable to tax in India. But since crude oil is important for India, these exemptions are provided to the foreign companies. Okay, my friends. So this completes our topic for today, TDS and exemptions. What we have discussed till now in the NR taxation chapter, we have almost completed the entire chapter. Now only some miscellaneous topics are left. We started with the very basic concept of residency. Then we slowly move to the advanced stage. And today we discuss even the IFSC provisions. And we also got to understand why these provisions were introduced and what was the national interest. So all these provisions are generally introduced to encourage to benefit the economy of India. You must understand the business to actually appreciate the related tax laws, because they both are very much related. Tax laws are introduced on the basis of the business practices being followed. Okay. So if there is any question, do ask me. Otherwise, we'll conclude the class for today and we'll meet in the next class. Okay. So good night. Thank you, Sanjay ji. So good night for today. Let's meet in the next class. Thank you. Yes, sir. Thank you.